Okay, here, you're good to go. Sorry for the delay.
No. Good morning again. Thank you for coming. So we're going to talk about taxes. I have a short presentation, and we got time for your questions when I'm done. So just a few little things here, a little legal disclaimer. So that's basically saying anything I say you shouldn't believe, because I just learned it this morning. We'll take your questions at the end. So what's the biggest issue with taxes today? It's not the tax returns, it's not the tax rates, it's crime. And it's happening every day, all the time, and it's happening in Georgia a lot. I got an article from the Atlanta Journal-Constitution. The FBI ranked Georgia in the top 10 in elder fraud losses in 2022. The numbers are just incredible. Just let me read this. More than 2,000 people in Georgia were victims of elder fraud in 2022, and Georgia citizens lost $79 million. That's money that's gone, it'll never come back. So how are these crimes happening? They're happening two ways. The first one is very innocently, you get an email, you get a text on your home computer or on your cell phone. Hey, I want to help you get some money. I want to help you recover some taxes. All you have to do is click on the link. Do not click on any links. Do not respond to any emails. This is how these frauds are happening. And what they do is they try to get you in very innocently. So there's two types of fraud. They have two names for them. One is investment and the other one is tech support. This is right out from the FBI. The investment is you start with a conversation online. Hey, I want to introduce myself. I want to let you know I've got this investment. If you start with 10,000, you'll see how well you do, and maybe you'll give me another 20 or 30,000, and you'll see how much better you do. This is happening all the time. And the problem is we're supposed to be better connected with the internet and with emails and phones, and we have a lot of people that live by themselves and think that someone is actually helping them. And they are not. They're there to take their money and steal it. And remember, once the money's gone, it's never coming back. And then the other one is the tech support, and this is the one from cell phones. You get a link, you get a text, you get an email, click, we're here to help you. Maybe we can help you recover some money from the IRS. Well, if IRS wants to send you money, they will. Okay, and if they think you owe money, they will let you know. And I know that the IRS has a bad reputation, but the IRS does have ways of which they do business. First of all, you're not getting a call out of the blue, you owe us money. Give us your credit card or debit card number, and you can pay what you owe. We're going to send the police to your house. That's not how they work. They will, if you're not in correspondence and gotten something in the mail, you don't owe them any money. And sometimes they're right, and sometimes they're wrong. But this is not going to come out of the blue and say, owe us some money, or go get some, tell you to go to the store and buy some gift cards and read us some numbers so they could steal some more of your money that way. Unfortunately, this is real, and it's happening. And if you get a call, don't give them any information. Don't talk to them. Hang up. Do not give them your name. Do not give them any information. Just hang up. Simple. Don't respond to texts and emails that you don't know where they come from. During tax season, a couple of months ago, I was working in the office on a Saturday, and I got an email that appeared to be from Kevin. Kevin at MagellanLegal.com with a whole bunch of zeros at the end of the name. So I knew it wasn't him. But the email was worded very nicely, saying, I need a favor, I'm short on time. Can you go to the store and buy five $500 gift cards? Call me when you do and take a picture so I can get the numbers, and then I'll meet you downstairs in the building and I'll give you the money back. Well, a couple things. I knew it wasn't Kevin, period. So I didn't do much with it or anything else. But this is what happens. It appears to be from someone I know. That's scary. It's very scary. And you have to pay attention. It could be from someone else I may know. It could happen to you. So what's the solution? If you get something like that and someone really needs your help, call them. Get on the phone and call them. I know Kevin's email. I don't need to be told what it is, and I know it doesn't have 20 zeros at the end. But that was easy to spot. But it appears to be very innocently sent. And help me out. We're all good-natured. We all want to help someone, but be careful.
Any idea as to how they would relate you to like Kevin? I mean, it had to be an employee or something.
So how do they relate? How do they find out? I know Kevin and Kevin knows me. I don't know if it's through social media. I don't know if they went on the Magellan website and saw two names and just decided to pick two names.
So you did open up that email.
I opened it, but I didn't click on anything.
Not to email.
And that's true. And that's true.
They know now you're alive.
Right. But I
So
didn't.
what you should do is move it directly to junk mail.
Well, I didn't respond, number one. I deleted it and didn't do anything else with it. But there was a follow-up, said, hey, I'm waiting to hear from you. Well, I deleted that one too. When in doubt, call someone. If someone needs you, you will know. It's real, that you will know.
The other thing, is that he copy voices. So you gotta be very careful about who you're talking to.
So the comment was made about artificial intelligence and they're copying voices. So that we're going to see how all that plays out because it's probably a lot more to it than just that. So remember, I just said a couple things, what the IRS does not do. You know what they do. If you owe money or they have a question, you're going to get a letter in the mail. You're not going to get, IRS does not text. IRS does not send emails. You're going to get a letter through U.S. postage in the mail. And that's what you respond to. Not a text and not an email. And not a call. Okay, they will never call you first and say, hey, you owe us X amount of money. Can I have your credit card number so we can take care of it? They're all smooth talkers. You're going to be surprised what I'm going to tell you. I have clients tell me what the tax law is. And they try. And what they do is they're trying to talk me into something. And so don't get your tax information from social media. That's not the place to get it. Get it from a reliable source. Reliable source is irs.gov. Reliable source is me and our office. And we can help you if you got any questions. The old saying is something's too good to be true. It's not true. It's just not true. There's no free money out there. There is a question that has been included on every return since 2020. And the wording of the question has changed every year. And it has to do with digital assets, cryptocurrency. If you file electronically, your software is going to answer that question automatically. And if you don't answer it or you block it, it's not going to go through. You're going to get an error. It's not going to go through. And so this is an area that the IRS is focusing on. They know there's hidden money there. They know that there's a lot of wealth that has been created through cryptocurrencies, and they want to get it. And so when you get your 1099s from the Magellan office, you get a form, 1099, interest, dividend, and sales. And the sales includes what was sold, your sales price, and your cost, and then from that you pay tax, and you pay tax on the gain, or if there's a loss, you deduct the loss. So IRS is working itself into regulating the companies that do the cryptocurrency to do the equivalent reporting that you see on your accounts here. It's coming. I just don't know when it's coming, but it's going to be here one of these days. And they're really pushing to get that done. And remember, even if you trade on cryptocurrencies, I have quite a few clients that give me their statements from Robinhood. Okay, legit. They have two accounts at Robinhood. One is a regular account, just like many of you would have, and the other one is an account that just trades in cryptocurrencies. There is no 1099-B for the one on the cryptocurrencies. So some clients have gone and told me, we don't have to report it. Well, I'm not going to do your return if I'm going to admit that. If you executed those transactions, it's reportable on your tax return. I'm not going to wait for the IRS to get this going and find out 2 or 3 years down the line that this should have been reported on your return. And what I don't understand is clients that tell me don't report it, it's not a big deal. The money they have in cryptocurrencies isn't a big deal. But that's not how it works in the IRS world, because one of these days those are going to be reported to IRS and they're going to be able to go back and get these statements. And then they're going to ask, you're going to get a letter in the mail. Notice I said you're going to get a letter in the mail. You're not going to get a call or a text saying, hey, we know about this. Answer some questions for us. And sometimes in every account that trades in cryptocurrencies that I've seen from my clients, they all have losses. Maybe there's a message there. This question changes every year. And the first year was 2020, and the question was worded that us practitioners didn't know whether it was yes or no. But they're getting a little better at it. There was went to a seminar, and a return. The speaker gave an example of a return that got selected for audit. It was a sole proprietorship, so he had a Schedule C. And so the question that he answered on his 21 return was, do you do cryptocurrency? He said no. So the IRS agent Googled his business, because the name of his business is on his tax return on Schedule C, and went into his website. And on his website was, you can pay us cash, you can pay us credit card, and you can pay us in Bitcoins. And he answered the question no. He didn't tell his accountant that. The agent had a field day, because that could be fraud, not answering the question correctly. And then they started going into his records with the Bitcoins, and how much money did you have, and where did the money come from, and was it included on his return? And the taxpayer said it wasn't included on his return because he didn't know how to value it. Well, that's not a reason not to include it. This is how, inch by inch, they're getting into that area. Okay, now we're going to talk about nicer things. I'm done with crime. I'm done with the cryptocurrency. So let's talk about the standard deduction. So for 22 on a married filing joint, the standard deduction is 25,900, and for 2023, because cost of living, it's going to be 27,700. And then if both spouses are both over 65, you get a little more, and that's what those numbers are. So why is this number important? And it affects a lot of people that are retired. It's important because if you have $40,000 or $50,000 of income and you have a standard deduction of 30, you're probably in the 0% bracket, and you left money on the table because you could do certain things. And some of the things you could do, you should consider, is a Roth conversion, taking more money out of the IRAs. We're going to talk about that in a minute. A little more on that. So this comes to help you. And for a lot of you, who in the returns I do, you're in the 10% bracket because of the standard deduction. This question comes up a lot, and I'm going to come back to this in a minute with the IRA planning. I get this question asked 3-4 times a year, every year. If I make a gift, is it deductible? No, no, no. If you make a gift to someone, is it taxable to the person that receives it? No. So the law has some limitations on how much you can give. You can give anything you want to, but if you give more than $17,000 in 2023, you need to file a gift tax return. And if married filing joint couple can give up to $34,000 and not have to file a gift tax return. Most people make gifts to their family, but you can make gifts to friends. You can make gifts to anyone you want to. You can give it to your neighbor if you'd like. Then there is a basic state exclusion, and focus on the money, on the number for 2023, $12,920,000. That means if someone passes away today and their estate is less than that number, there's no estate tax to pay. There's a danger with that number. So in 2017, the Tax Cut and Jobs Act was passed by Congress, and it only went up 10 years. And so a lot of the provisions that were very beneficial to taxpayers expire on December 31, 2025, unless Congress steps in and changes the law. And there's a chance that may happen, or they may change it and repeal it altogether. And if Congress does nothing, it's going to go back to $6 million. And for $6 million per spouse, some of you could have estate subject to estate tax. Or at least you set it up so when the second spouse passes away, there could be estate tax. So there can be, if it goes down, you should probably be consulting us to see what you can do for the planning. Yes, I was going to get there. Yes. So that basis exemption is $12,920,000. So if any of that exemption is unused, it goes to your current spouse. So when your current spouse passes away, he or she gets whatever the exemption is in the year he or she passes away, plus the unused exemption when spouse number one died. So it could be a big, big benefit. Yes, so portability is an election. It's not automatic. You have to file a 706 in order to get it. And that's not that hard to do, and they simplified the reporting for portability elections. Can only come back and help you. If in doubt, I recommend filing. And particularly if you've got more than $6 million in assets, which could come down. I don't think it'll be down below $6 million, but it could come down to $6 million. And then it gets indexed for inflation each year.
Just have one more question. Let's say you had portability, you elected portability, exclusion amount that reduced it? Or
You still get the portability from the year the spouse number one died. And then whatever the exclusion amount is when spouse number two passes away, that's the exclusion for spouse number two.
They couldn't retroactively change it?
No, no. It's just something to keep in mind. And remember, real estate holdings are going up, values are going up. It's not that hard for some of you to get to 6 million. Any questions on that? It's just a little of a hard concept. So everyone has an annual gift tax exclusion. That's the 16 and 17,000 that's up there. And then everyone has the basic estate and gift exclusion. And that's the higher number.
Do you just get the Form 706, fill it out, and send it back to the IRS?
So the question is, what do you just fill out Form 706? Well, 706 is, let's just say, requires a lot of work. Okay? And you wouldn't want to do it on your own. You'd want to hire someone like me to do it. And there's a whole bunch of attachments that go with it, and other elections that you may have, and depending if you've got a taxable estate or not. So, but if you should go to the IRS website, and on the search field, on the top right-hand corner, put 706. It'll take you to the form, it'll take you to the instructions. So you could see. I think the instructions are more pages than the forms.
Henry, is that tax exclusion per year or per lifetime?
So the 16 and 17 is per year. This one, the bottom number is per lifetime. So you've got to be really wealthy to give away $12 million. I haven't seen it. And by the way, when you make a gift to someone, it doesn't have to be 0 or 17,000. It could be something in between. You can make 2,000, 3,000, 5,000. And there's something in the law called qualified transfers. And a qualified transfer is when you pay education or medical expenses for someone. And so it doesn't count as a gift. But the only requirement is if you want to pay university costs for a child or grandchild, you have to pay it directly to the university. If you're paying medical costs because you want to help a family member pay his or her medical costs, you have to pay the medical provider. You don't give them the check and then they deposit and write the check to the medical provider or the education facility. You have to give it direct. And it doesn't count against the 17, and it doesn't count against the 12,920,000. Yes.
Now, if you give somebody a check,
Okay, good question. So the question is, how does IRS know you write someone a check for $94,000? So the tax law has an answer to your question, and you're not going to like part one of my answer. So the general rule is that any income you got is taxable income unless the law gives you an exclusion. And certainly gifts is an exclusion. So if a taxpayer got audited, they received the $94,000, and the taxpayer tells the IRS agent that was a gift from someone. And then the agent's going to say, no problem, who made the gift? And they're going to go to their website and make sure, to their records, and make sure that the gift tax was filed. If the gift tax return was not filed, that $94,000 is income to that person. That's why you file a gift tax return.
the person just puts it in their checking account and don't declare it, how would anybody know they don't?
You have to get audited. You need to get audited in order for someone to find out.
You have to be audited by
Yes,
the IRS. Okay.
yes. And when you get audited, they will ask you for the receipts for that year of audit.
Is there any rule that banks have to advise the IRS if people deposit more than $100,000 or something?
The answer is, the banks have any reporting responsibility when you make a deposit to your account? And the answer is no. The only thing the banks need to do is someone deposits $10,000 in cash, they need to report that to the IRS. Okay. But what you're doing by filing the gift tax return is you're protecting the donee, the person that received it. I have argued with clients that don't want to file the gift tax. Oh, no, I don't want to get them in trouble. I said, you're getting them in trouble if you don't file the gift tax return. In fact, I finished one this morning where a mom gave her son about $90,000. And the son, and I called the son up, I said, I need some information from you. Oh, no, I don't want my name on it. I said, you have no choice. I'm reporting the gift because your mom said to report the gift on the gift tax return. He wouldn't want to give me his address. He's afraid he's going to get caught. I said, you're not going to get caught. I said, you're going to get caught if we start giving wrong information. This is simple. Do it right, and do it right the first time, and it's done. And you don't have to worry about it. I answer all your questions about the gift tax. A question that comes up very often is medical expenses. What's deductible? So in order to deduct medical expenses, you're going to meet two tests. The first test is got to be greater than 7.5% of your income, and the second one is you got to itemize, which goes back to that standard deduction. For a lot of you in this room, you do not itemize because the standard deductions are so high. So even if you do get over the 7.5% of income because you have a lot of medical expenses, you still may not itemize. So what can you do? If you think you have a lot, you may want to bunch them up as much as possible. And you may want to pay everything you've got outstanding. You cannot prepay medical expenses for the next year. That you can't do. But you can, and up there on the screen, insurance, copays, medical premiums, the Medicare withholding, long-term care premiums, prescriptions, all that's included in there. The doctor says, I think you should take a good multivitamin every day. That's not deductible. You shouldn't. You should still take it, but that's not deductible. So if it's prescription vitamins for some reason, the answer is yes, you can deduct it. Any questions on medical expenses? Most of you who I do your returns, you don't deduct them because of the 7.5% and you don't itemize. You heard something in the tax law called Secure 2.0. So it was a law that affects IRAs and retirement plans. And so Congress decided to take something simple and make it complex. So the RMD age increased from 72 to 73 in 2023. In 2033, that's not a misprint, it goes to age 75. Why did they pick 2033? Number one is they have time to think about it and make a change if they want to. And then the other thing is, remember, if you leave the money in the IRA, the more you leave it, that means your RMD is going to be larger the year you start taking it. Remember that standard deduction that I've been talking about. So it may be time to do something that's counterintuitive, and before your RMD kicks in, start taking money in the IRAs, use the standard deduction to help you reduce or pay no taxes. That's the importance of, one of the importance of the standard deduction. Or do enough to stay in like the 10 or 12%. And also when you do your IRA distributions, the law says you have to do your IRA distributions, but you can get the securities paid to a taxable account, and that counts. So if you have a security that's got a value of $10,000, that gets transferred to your regular account, that you're taxed on $10,000. You've heard of something in the law called qualified charitable distributions, QCDs. A lot of you do it because I work with Blake on them. And that is money goes from the IRA to a charity, a 501c3. Goes directly from your account to the charity. It does not come to you and then you write the check. And so the law on this is sort of mismatched. You could do the qualified charitable distributions once you turn 70 and a half, but it really doesn't do you much good. But once you turn 73 or 75, that's when you want to consider doing it. Most of you don't itemize, and you do want to support charities, so the smart thing to do is to do the qualified charitable distributions. So if my RMD is 17,000 and I want to give 7,000 to a charity, and I do that from my IRA, I get to 10, regardless of whether I itemize or not. If you don't itemize, you're ahead of the game. See how this is all interrelated with the income, the standard deduction? That standard deduction number can be used to your advantage for planning.
When you're converting a regular IRA, a deductible IRA that you already have not paid taxes, and you're converting to a Roth IRA, you pay the taxes at that point.
So the question is, I think he's going to have some more, is when you convert an IRA to a Roth IRA, do you pay the taxes up front? Yes.
Okay.
So I go back to the standard deduction. You may be able to do enough to reduce your taxes because the standard deduction is so high, you may not have to pay tax, or you may pay tax for the 10 or 12% bracket.
Would you consider paying up to 20%?
That's up to you.
Okay.
That's up to you. At some point, the Georgia taxes may kick in. And so what happens is there's an interplay of how much your Social Security is taxable, because if you do a Roth conversion, your taxable income is higher, means more of your Social Security is taxable. So this could be like if you do, let's say you take a $10,000 Roth conversion, you convert it, your taxable income is going to go up 10, it may go up another 4 because more of your Social Security is taxable. That doesn't mean you've done something wrong, but you want to know that ahead of time. And the only good thing I can tell you about more of your Social Security being taxable is Georgia doesn't tax Social Security. I'll be talking about Georgia in a minute. Okay, should you do a Roth conversion? That's a question that is different for everyone else. There was a article in the Wall Street Journal. Her name is Laura Saunders. Several years ago, she came up with an article advising on Roth conversions. The journal had received about 3,000 or 4,000 comments on that article. She came back the following week and said, it's more of I shouldn't say you should do it, you shouldn't do it. It's more of an individual question. You got to decide what other income you have and what the tax rates are.
So you just have to find out the break even.
Yes. Yes, and we remember for 2023, we know what the tax rates are, we know where the points are, we know where the 12 and the 22 and the 24% end. And then it's up to you how much you want to take. So what are the advantages of doing the Roth conversion? Reduces your RMDs going forward. But there's a price to pay because you got to pay the tax up front. It's not a free lunch.
True, but you're betting on the tax rates going, if you're betting on the tax rates going up, then it's beneficial at this time.
Correct.
To take it
Correct.
at 20 or 22%.
Right. Okay. I can tell you what the tax rates are going to be for 2023. I cannot tell you anything about 24 and going forward because we just don't know. And you don't want to do this on December 30th. You don't want to call us. You don't want to call any other IRA trustee because they're going to be inundated and it ain't going to happen. Kevin.
Can you speak to charitable fund claims for just a minute with regard to people who give money to charities and yet are not able to deduct it because of
Okay.
the deduction?
So once again, we get back to the standard deduction number. So a time to consider Kevin's called it charitable bundling. That's when you contribute like 2 years of contributions in 1 year. You get the tax deduction the year you contribute it. So, for example, if you normally do not itemize, but you have higher medical deductions, and maybe you meet the 7.5% test, you may want to consider doubling your charitable contributions so you're over the standard deduction. Now, there's just a little like asterisk I want to say with that comment. The standard deduction was about $30,000. So if your itemized deductions are $35,000, which is a good number, you're in effect getting a deduction for $5,000. The law gives you the $30,000, whether you do it or not, whether you contribute it or not, whether you use it or not. So we just got to plan for that and at least know you're going to get a benefit, but it may not be as much a benefit as you think.
Again, you have to use a break-even point for each individual.
Well, in this case, you'd want to know, you sort of got to, remember, you got to do this before December 31st. You need to know what your medical expenses are going to be, and you need to come up with a good, accurate number of your income, because the first 7.5% of your income is not taxable, is not deductible as medical expenses. Georgia. What do we have? What's north of Georgia? Tennessee. And what's south of Georgia? Florida. And what do those two states have in common? No income tax. No personal income tax. So Georgia said, we're getting tired of retirees retiring and moving to Tennessee or moving to Florida to avoid the state income tax. So Georgia said, we want you to stay here, so we're going to make it appealing, tax appealing to stay. So between 62 and 64, you get to exclude $35,000 of your income on the Georgia return. The federal income stays the same, no change on that. At 65 and over, you get to exclude up to $65,000. So for husband and wife, two spouses that are wealthy, they can each potentially exclude up to $130,000 on their Georgia return.
Starting at age
65. Between 62 and 64, it's $35,000 per spouse.
And that's going to go into effect next year?
It's in effect now. It's in effect now. It's in effect now. It's been the law for many years.
I'm sorry. So if you turn 65 this year.
You get the $65,000
Per individual.
per spouse. Well, if one spouse is 65, if spouse number 1 is 65 and spouse number 2 is 63, then you get the 65 and the 35. And Georgia doesn't tax Social Security. That's taxable on the federal return. And Georgia doesn't tax interest income from U.S. Treasuries, U.S. government obligations. The federal government does. That's just a little confusing. So if you get savings bonds or you have T-bills, interest from T-bills, that's fully taxable on the federal return. It's not taxable on the Georgia return. So Georgia is a pretty good state for basically people over 62 and over.
Henry, how many states do that?
Some states, the question is how many states do that. So different states have different ways. South Carolina, for example, has a $15,000 retirement exclusion per spouse, and that's all they give you. And also some states you do the itemized, you don't do the itemized, and also the tax rates could be slightly different. But Georgia's pretty good. Okay, have any of you received $250 or $500 from the state of Georgia? Yeah. Okay, so why did you get that?
Kent gave us a gift.
That's right. Okay, so with so this is the second year that the Georgia legislature passed the bill. As long as you're on a single return, as long as your tax is greater than $250, you got a $250 rebate. On a married filing joint return, as long as your tax is greater than $500, you got a $500 from the state. Because I'm getting emails from clients saying, I got my Georgia refund and I got a $500 check. What did I do? What'd you do? Okay, I didn't do a thing. That $500 or the $250 check, that's automatic. As long as the return is processed, the state is actually doing a pretty good job of sending that money to taxpayers. The government, the state of Georgia, is refunding the budget surplus to taxpayers.
And you have to be 65 to receive it?
No, you're talking about the 500, the 250? No, you have to file a Georgia return, and your tax got to be greater than 250 or 500. If your tax is 140 on single, you're going to get 140 back.
And how do you get the check back? In the U.S. Post Office mail?
So if you do direct deposit for your regular Georgia refund, this will be direct deposited. If you get a check in the mail for your Georgia refund, they will send you a check in the mail.
So those checks have already started coming out?
Yes. 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 When did you file?
Pardon?
When did you file?
2 weeks before the due date,
Okay, you should have gotten them by now.
and it was filed electronically.
Okay, so let me ask you a personal question. Was your tax greater than 0? Your Georgia tax? Okay, so you should have gotten it by now. Okay, if you do direct deposit, check your bank statement to make sure it's not there. No one sends you a notice saying, hey, we sent this to you.
So it's a direct deposit type thing?
If your regular overpayment is direct deposit, this will be direct deposit.
What if you don't get a refund? You owe taxes, you still get the bonus?
Yes. Yes, the question is if you owe taxes. It has to do with what your Georgia tax liability is that year. If your Georgia tax liability is 0, you're not getting any money back. Because, and quite a few of my clients, when I do the kids and I do the mom, and the mom's income is, because mom is over 65, her Georgia taxable income is 0, it means her Georgia tax is 0, so mom's not getting a $250 refund. Your tax has got to be greater than 250 or 500, or if it's or in the middle. If your tax is 0, you're not getting anything. So the IRS stirred the pot a little, and they came out and they said some of this 250 or 500 could be taxable. So what they did earlier this year is they told the states to stop sending the money out until we figure it out. So I'm going to give you just a little complicated answer to it. Is it taxable or not? If you take the standard deduction on your individual return, once again, that number again, it is not taxable. If your taxes are greater than $10,000, real estate taxes, state taxes, all your other taxes, it's limited to $10,000. You did not get a tax benefit, so you don't have to include it in income. I was surprised that one of my clients, she set up an account with the Georgia Tax Center, and she printed me her 1099-G for 2022. And I looked at it, and it's a good thing she did, because I may have missed that. It wasn't totally done. So her refund amount was $250 higher than what I showed on the return last year. I said, that's strange. How did I miss $250? And then I realized they included in taxable income her $250 from the prior year. They may not do it right all the time. I'm done. I have some questions. I want to go over one thing, and then if anyone else has any questions. And this question came up actually last week, and my client had a tough time understanding. Let's just say you do itemize, because your deductions are greater than the standard deduction, and you make a $5,000 charitable contribution, are your taxes reduced by $5,000? The answer is no. What is the tax benefit? If you're in the simplified 20% marginal bracket, your taxes are reduced by $5,000 times 20%. You do not get a $5,000 dollar for dollar deduction on your federal return. Because a lot of people say, oh, I'm going to give charity this amount so I can bring my taxes down to zero. It doesn't work that way. Questions? Anything else?
I've got a question. What are your thoughts regarding the 87,000 IRS agents that are being hired? I understand they're during their recruiting at the state and federal
Okay,
prisons.
so, no, not exactly. Okay, so the question that was asked about the 85,000 that Congress authorized IRS to hire. So that 85,000 is, the first part of that 85,000 number of people is to replace people that are retiring. And the problem with that is there is a lot of experience going out the door as these people retire, because they've been with the service. Most likely, for a lot of these people that are retiring, they've been with the service all their life. So each person could be taking 25, 30, or 35 years of experience. So just because you replace that person with another person doesn't mean you're going to get the same level of production. That other person needs to be trained. Okay, and their system is not you and I working on our home computers or doing a software update. It's massive. So it's going to take years for that to filter through the system. As I read in the paper, what's going on with the debt, with the national debt, and the Republicans and the Democrats are going back and forth. The Republicans are saying they want to eliminate that 85,000 people for IRS. So we'll see where that ends. But also, it takes time to train people. Without bragging about myself, I could probably start working in the IRS in a couple of weeks. I would be productive. That's because of my experience. But most people that work somewhere else, they've got to be trained. It takes years to do that, and it costs money. We don't know yet how that's going to play out.
And facetiously, they're doing their recruiting at the state and federal prisons to get these people in free trade.
I don't know where they're recruiting people. Okay, I don't think that's the case, but it's tough to get qualified help. Anything else?
Just one comment. There's incredible amounts of fraud right now in emails and stuff. I just got one purporting to be from Kohl's that I want a cookware set. What they're after is they're going to want to charge me a shipping fee, and they want to get my credit card information. Almost all these prizes are all fraud. You get an email, which I got yesterday, that my Amazon account has been frozen because of a questionable transaction. It's a fraud. You go to your Amazon account on your own, independently, your account's gone. Was there any problems this year? I've heard about this in the past, but didn't hear much this year about fraudulent early filings by criminals of your tax return?
They are getting better at it, and every year it gets better and better. There was something that I read in the past week that IRS has flagged 1 million returns for fraud, but they didn't quite define what fraud means and how that works. They are getting better. It used to be, I would say, when we started e-filing, I would have rejections, for whatever the reason. And now we're getting less and less of it. The system's working much, much better. E-filing is the way to go. You should not be paper filing your returns. That is so 1900s. So the question that Kevin asked is, filing an extension, what does it mean? What does it do to you? So filing an extension is an extension to file. It is not an extension to pay. Theoretically, if you owe money, that money is due April 15th. And if you pay 90% of what you estimated your tax to be, you just pay the tax and a little interest. And that's it. You're not put on a bad list. You're not subject to audit. You're not moved to another column that says, you're a deadbeat. or no means. And remember, what's happening in today's world is reporting from 1099s is taking longer. We see it in our office. When I started in public accounting, on January 31st, every 1099 was out. It was simple. Getting a return done by April 15th was easy. Now, sometimes we don't get them to March 15th, and then you get the corrected 1099s. You know, they come out a week later. So the reporting has been been making it more complex. And the other thing is a lot of businesses are done through flow-through entities like LLCs and S corporations. And so if you don't have, those returns are due March 15th, and most of those get extended. But if you extend that and you don't have your business return done by April 15th, you can't file. So another reason to probably you'll need an extension. But there's nothing wrong with it. And the problem with the business return is, in particular if you have inventory, you may not know what the profit's going to be or loss. So you estimate the best you can. But file the extension. And then you do the paperwork afterwards. Anything else? Well, thank you. Thank you all for listening. Thank you for your participation.